The S&P 500 just had its first perfect week of record highs since 2021. But what if this market euphoria is hiding a storm? Welcome to Value-Aligned Insights. This past week, U.S. markets exploded, with the S&P 500, NASDAQ, and Dow all gaining over 1%. On the surface, it's pure celebration. But dig deeper, and you'll find a complex web of economic contradictions, geopolitical chess moves, and surprising shifts in investor behavior. We'll break down what truly drove the market, the standout sectors and stocks, and crucially, how our value-aligned model portfolio navigated these turbulent waters. Stick around, because understanding these nuances is key to protecting and growing your wealth. Hi folks, Berk here. Let's start with the headlines. The S&P 500 closed at a record 6,389, marking its fifth consecutive record close and its first perfect week of all-time highs since November 2021. The NASDAQ composite wasn't far behind, hitting an all-time high of 21,108, closing at a new record in 9 of the past 10 sessions. Even the Dow Jones Industrial Average climbed, nearing its first record high since December, and the small-cap Russell 2000 outperformed everyone, gaining 3.4%, signaling a rebound in smaller companies. This broad-based rally was fueled by optimism around a potential US-EU trade deal and a generally positive corporate earnings season. However, there's a crucial detail. Trading volume was relatively light, just 17.7 billion shares traded, below the 20-day average. This suggests that while the headlines are celebratory, a cautious undercurrent remains. Investors are still holding their breath, especially with a Federal Reserve meeting right around the corner. Now let's peel back the layers and look at the economic forces at play. The U.S. economy in June presented a complex picture. The leading economic index, or LEI, which forecasts future economic activity, actually declined by 0.3%. This suggests potential headwinds, with weak consumer expectations and rising unemployment claims. Yet the Coincident Economic Index, or CEI, which reflects the current state of the economy, rose by 0.3%. This divergence is critical. Current stability, but warning signs for the future. The Conference Board even projects GDP growth to slow to 1.6% for 2025, partly due to tariffs. Adding to the complexity, inflation ticked up. The Consumer Price Index, or CPI, increased 0.3% month over month, bringing the 12-month rate to 2.7%. Core CPI, excluding volatile food and energy, rose 2.9%. This rising inflation, coupled with slowing growth projections, creates a challenging environment for the Federal Reserve. Speaking of the Fed, markets are heavily pricing in a 60% chance of a rate cut by September, even though the Fed is widely expected to hold on rates at its July 31st meeting. President Trump continues to push for lower rates. This expectation of cuts is a significant tailwind for stocks, but if inflation persists, the Fed might disappoint, leading to volatility. Beyond economics, geopolitics, and U.S. political developments were major market movers. The most significant catalyst this week was optimism around a potential US-EU trade deal. President Trump hinted at a 50-50 chance of a deal before he met with European Commission President Ursula von der Leyen. The August 1st deadline looms, with threats of a 30% tariff on EU imports if no agreement is reached. However, reports suggest a 15% baseline tariff might be agreed upon, which, while still a tariff, is seen as avoiding a much worse outcome, and markets reacted positively. Globally, trade faces headwinds from policy uncertainty and geopolitical tensions. Digital markets are consolidating, with major tech giants dominating, especially in the rapidly expanding generative AI space. This isn't just about economics. AI is at the heart of US-China strategic competition, fueling a tech decoupling. This means ongoing trade uncertainty is the new normal, and AI investment is now deeply intertwined with geopolitical risk. Domestically, U.S. political developments also had a direct impact. The Genius Act, signed into law on July 18th, is the first primary crypto legislation, clarifying that stablecoins are not securities and establishing precise regulatory requirements. This is a significant victory for legal certainty in the cryptocurrency market. The Clarity Act also passed the House, aiming to classify digital assets as securities or commodities. These acts could attract significant institutional interest. Finally, President Trump's direct influence remains strong. He's pushing for new tariffs to take effect on August 1st and continues to call for lower interest rates, although the Fed remains firm. This executive dominance creates a less predictable environment, meaning investors need to pay close attention to policy shifts. Let's look at who led and who lagged among the S&P sectors. 9 of the 11 major sectors advanced. Healthcare was the strongest performer, gaining 3.27%, likely due to defensive positioning and positive corporate news. Industrials followed closely, rising 2.46%, as optimism over trade deals and economic resilience drove the gains. On the other hand, consumer defensives were the weakest, rising only 0.33%. And notably, technology, despite high earnings expectations, lagged with a modest 0.6% gain. This suggests investors are scrutinizing tech valuations, especially given the massive capital expenditures required for AI development and increasing competition. Individual stocks experienced significant fluctuations. On the gaining side, Decker's Outdoor surged 11% after reporting better-than-expected quarterly results, driven by strong international demand for its UGG boots and Hoka sneakers. Newmont, the world's largest gold mining company, jumped 6.9% after exceeding quarterly sales and profit estimates, bolstered by higher gold prices. VeriSign, a provider of internet infrastructure services, climbed 6.7% following an increase in its share repurchase program. Verizon shares jumped 4% after reporting strong Q2 results, driven by better-than-expected gains in broadband internet subscribers. Block surged over 7% following the announcement that the digital payments provider would replace Hess in the S&P 500. But a fascinating trend was the resurgence of meme stock trading. Companies like Kohl's, Opendoor, 1-800-Flowers, GoPro, and Krispy Kreme saw rapid price surges. This indicates a big appetite for risk among retail investors, with Goldman Sachs's speculative trading indicator reaching levels not seen since the dot-com bubble. Opendoor, in particular, soared around 50% this week alone. This speculative frenzy could signal an overheated market in specific segments. In the crypto-related space, Trump Media and Technology Group was up 5% after announcing it had amassed roughly $2 billion in Bitcoin, and Strategy also saw a 2.5% increase, having purchased thousands of Bitcoin last week. On the losing side, Intel tumbled over 8% after forecasting steeper quarterly losses and announcing job cuts, which hurt the broader chip sector. Charter Communications plunged 18%, following a sharper-than-expected loss in broadband subscribers, attributed to intensifying competition from 5G bundles. Centene fell 15% after missing analyst earnings estimates and cutting its 2025 outlook. Natural gas companies, including EQT, Expand Energy, Coterra Energy, and Targa Resources, saw their stocks decline as natural gas futures prices dropped due to elevated production levels. Now, sometimes you get lucky, but I'd rather say what my old colleague Chuck used to tell me: the model doesn't lie. What he meant was, if you stick to a systematic process, you avoid the traps of emotion, bias, and market noise. That's what we did here. And it worked. We made a few deliberate moves in the taxable portion of the value-aligned portfolio. We trimmed back some of our biggest winners, NVIDIA and Broadcom, right-sized them back down to their original model weights. Why? Because discipline matters. These positions had grown large and expensive by our standards. At the same time, we added to the existing positions of 2 stocks whose math and mission aligned. We increased our position in Medpace Holdings, and Advanced Micro Devices initiated a new stake in Novo Nordisk. This wasn't market timing. It wasn't some heroic bet. This is just what we do, week in, week out. When a position runs hot, we trim it. When a great business is trading at a discount, we buy more. So yes, we had a standout week, but the real story is the process. the one we stick to without fail. That's what powered the gains. That's what protects the downside. And that's what leads to real wealth over time. Now let's dig into the performance report so you can see precisely how those moves played out. Beyond the broader market, our value-aligned model portfolio, VAP, demonstrated notable performance this week, outperforming major indices. The value-aligned portfolio increased by 3.6% for the week ending July 26, 2025, surpassing the broader market, and is now up 9.1% year-to-date. The portfolio benefited from strong showings in healthcare and semiconductors, aligning with sector trends. The 5 best-performing VAP stocks for the week were Medpace Holdings, MEDP, $443, up an outstanding 43.5% as short sellers ran for cover, and that brings it up 34.7% year-to-date. Medpace provides comprehensive clinical trial services to small and mid-sized pharmaceutical and biotech companies, focusing on outsourced research and development. Thermo Fisher Scientific, TMO, $478, up 15.3% for the week, down 8.1% year-to-date. Thermo Fisher offers analytical tools, lab equipment, and services for scientific research, diagnostics, and biopharmaceutical manufacturing. We have owned TMO for nearly 20 years. It has returned 14.3% per year over the past 20 years. Thermo Fisher's value proposition lies in its one-stop shop approach, delivering comprehensive solutions that accelerate research, optimize productivity, and streamline laboratory and manufacturing operations for scientific and healthcare clients. Number 3, another healthcare company. Novo Nordisk, NVO, $72, up 11.5%, but still down 16.7% year-to-date. Novo develops and markets treatments for chronic diseases, primarily diabetes and obesity, with a focus on innovative biologics. Remember, we bought this stock for the first time last week. You get lucky now and then. Number 4, Installed Building Products, IBP, $204, up 11.1% and up 16.7% on the year. This family-owned company continues to grow by buying up independent installers of insulation, waterproofing, and other building products for residential and commercial construction projects. And number 5 is Advanced Micro Devices, AMD, $167, up 6.0% and up 37.8% for the year. Another stock we bought last week to add to our position, and another lucky bet. AMD designs high-performance chips, including CPUs and GPUs, for PCs, servers, gaming, and artificial intelligence applications. The 5 worst-performing VAP stocks for the week were the worst: Interparfums, IPAR, $121, down 6.5% for the week and down 8.0% year-to-date. Licenses and produces prestige fragrances and beauty products for global distribution. Number 2, Tesla, TSLA, $316, down 4.1% for the week and down 21.7% for the year so far. Tesla, of course, has the most significant worldwide electric vehicle market share, but also sells renewable energy storage and autonomous driving technology. And don't forget its investment in AI and robotics. Number 3, ASML Holding, ASML, $712, down 3.2% and up 2.6% YTD. The only supplier of the massive and unbelievably expensive photolithography systems essential for advanced AI chip production. Number 4 was NXP Semiconductors, NXPI, $223, down 1.2% week-to-date and up 7.4% for the year. NXP Semiconductors develops secure connectivity solutions for automotive, industrial, and IoT applications. And the 5th worst for the week was Kinsale Capital Group, KNSL, $477, down 0.6% for the week and up 2.6% YTD. Kinsale underwrites specialty insurance in excess and surplus lines, targeting niche risks. You know it was a good week when your worst stock was down by only 0.6%. Looking ahead, the market remains cautiously optimistic, with key events such as the Fed meeting, ongoing earnings, and the August 1st tariff deadline. The current environment demands a long-term investment approach. At VAP, we believe in navigating these complexities by focusing on number 1, buying great companies. Number 2, don't overpay. Number 3, do nothing. Let it ride, and let aligned management teams adapt as things outside our control happen. Get your free estate planning checklist kit at the link below. Visit us or contact us for a personalized consultation. Cheers.
Videos are not financial advice. This information is provided as an informational resource and should not be viewed as investment advice or recommendations. The decisions on how to invest, when to retire, and other financial planning topics are some of the most important financial decisions you will make. Please seek professional financial advice as you make this decision, ideally from a financial advisor, a CPA, and an attorney. Having the perspective of all 3 professions will help you make the right decision for you and your family. This information is being presented without consideration of the investment objectives, risk tolerance, or financial circumstances of any specific investor and may not be suitable for all investors. This information is not intended to and should not form a primary basis for any investment decision that you may make. Always consult your legal, tax, and/or investment advisor before making any investment, tax, estate, financial planning considerations or decisions. I don't believe in get-rich programs. Instead, I believe in doing your homework and working with professionals who are fiduciary to you 100% of the time. Investing in securities involves a risk of loss. Past performance is never a guarantee of future returns. Investing in foreign stock markets involves additional risks, such as currency fluctuations. The foregoing constitutes the general views of ValueAligned Partners and should not be regarded as personalized investment advice or a reflection of the performance of ValueAligned Partners or its clients. Nothing herein is intended to be a recommendation or a forecast of market conditions. Instead, it is designed to inform and educate. Present and future markets may differ significantly from those illustrated here. Not all past and future forecasts may be as accurate as those predicted herein.